Hello and welcome to Wisdom Bites. Hope you're well. Thank you once again for joining us. Very much appreciated. And in today's video, I'm just going to show you two particular charts which no one seems to be watching at this moment in time. And both charts are never wrong. But one of them is about to flash a signal which, if you miss it, it will cost you big time. So if that sounds interesting, then without further ado, get yourself a cup of tea, sit yourself down, eyes on the screen, and let's get cracking. But before I begin, the usual polite reminder, please remember everything in my videos is just for educational purposes. So please always do your wider research before you make any investment decisions or any swing trade decisions. So what is this chart that's never wrong and is about to flash a new signal? And if you miss this, this will be absolutely costly, and this will only come once every 4 years. So just to explain exactly what these lines are here, the red lines are the halvings every 4 years, and the yellow lines are the tops of each of the previous 3 bull markets. The chart that I'm talking about is the stock to flow chart, which I haven't shown you for the last 2 years, but it's about to flash a signal which always happens around the same time every 4 years. But before I give you the insight into the chart, I just want you to know exactly what this stock to flow chart is. So this particular indicator, as it says here, is a popular model that assumes that scarcity drives value. It is defined as the ratio of the current stock of a commodity, i.e. bitcoins, and the flow of new production, and is applied across many asset classes. Bitcoin's price has historically followed the stock to flow ratio, making it a popular model for predicting future Bitcoin valuations. And the heart of this model is really to do with the scarcity. And if you watched my last video, I highlighted this, that as we're coming towards the halving, the amount of bitcoins available to trade, for the various reasons I highlighted, has been going down and will continue to go down, while at the same time we've now got a perfect storm for a bull market, because the demand at the same time is actually going up and will continue to go up with the backdrop of the ETFs. So as you can see from here, the stock to flow model predicts value changes in a more straightforward manner. It compares an asset's current stock to the rate of new production, or how much is produced in a year, and a higher ratio suggests greater scarcity, which generally leads to higher prices. So this is what we're talking about. And if you look at the first cycle here, the red line, as I said, is the halving, and the yellow line is the tops of the 4-year cycle. So the thing to notice here is that before the halving, this red line, so what you see is that before the halving, you see the stock to flow, the yellow line, shoot up because of the increased scarcity, where the supply falls and the demand increases. And just notice the price, that there is a divergence of the stock to flow to the price level. And then what follows afterwards is the price level then comes and meets that stock to flow ratio line over here. And that usually occurs before the top of the bull market. And if we have a look at the second cycle, we can see quite clearly the same pattern develops one more time. Before the red line here, before the halving, the stock to flow ratio is telling us that scarcity has increased, and then the price, like clockwork, comes to meet the higher stock to flow ratio, and that happens just before the top of the market here in 2017. And if we move to the third cycle, once again, before the halving here, the red line, the stock to flow line shoots up because of the scarcity, and the price, like clockwork, follows it all the way up just before the topping of the market. And the million-dollar question is, what is happening now? If we have a look at the current cycle, we can see quite clearly that we're coming up to the halving, and you can see with this line here, scarcity is about to increase, and we're going to shoot off somewhere around here, wherever that's going to be, and we're going to get a divergence of the price. And what follows, if the historical narrative is to be believed, and we have no reason not to, we're going to get a catch-up of the price, wherever that's going to be. It could be at 100, 200, 300, wherever it's going to be. Now, the problem is that we have a lot of information out there by people predicting the price to be 90,000, 100,000, 120,000. And obviously that is a possibility, and that is the ballpark figure that I've been thinking about. But at the end of the day, no one really knows. Just like over here, nobody could have predicted 69,000. And I remember the predictions before this were anywhere in the region of about $200,000 to $300,000. And now the predictions are much more conservative because of what's happened over here. So everybody's thinking 90, 100, 110, 120. But what if the price is much higher this time, 200, 300, 400? So what I'm trying to say is that we must keep a neutral stance. In essence, the price can be anywhere between 90 to 400, 500,000. And there is a theory out there of the 5.3 of what's happened in the past. And obviously we've got to respect that, but that doesn't mean that it has to happen. And that's why it's very important to always keep a fluid and flexible approach to all the things in the charts and let the charts dictate our narrative. So here it is, the signal that's about to flash before this halving. And as you can see, wherever it's gone, the price generally follows and tops out around about the same time. So we will expect wherever this goes, if it's here 200, 100 down here, or 300 up here, this is the end point here. The yellow line is the end of the current 4-year cycle. And for those people who are still thinking that we're going to go down to 12 and 10 and 3,000 and whatever other number comes to mind, just like what's happened in the past, whenever we've come near the halving, everybody's still expecting these prices down here. But as you can see, they don't come back down. And this was an odd situation of the COVID. And the second chart I'm going to show you is one I've shown you for the last 9 months, predicting the price of the first peak. So what is the first peak? The first peak is that when we've bottomed out from a rally up here, you can see that we bottomed out at this point, and at the end of each bear market, what we've got is that before the halving, this red line, the price has an affinity towards coming up all the way up to the red line of the pi cycle. So this is normally the first peak that we get before the halving. And as you'll see in one of the cycles, we got 2 peaks. So this is the pattern that's repeated in each of the cycles. Because as you'll see from the second cycle, the same thing happened one more time. This is the second cycle here. Once we'd bottomed out at the bottom of this bear market, this double bottom, the first peak came all the way up to the red line, and there was a second peak here, all before the halving. So you can see that the halving has some sort of a magic effect on the price coming all the way up to the red line here. And in the third cycle, once again, at the end of this bear market, we bottomed out, and before the halving, we got our first peak here in June 2019, and there was no second peak here. And in this current cycle, the same pattern seems to be repeating. And I've been talking about this ever since the end of last year, that when we came to the bottom of this market here, around this time, when we were calling for the end of the bear market, I said that before the halving next time here, that we will be bringing the price all the way back up to the red line one more time. And this is exactly the trajectory of this, where it's going now. So the question is, where is this price now? You can see quite clearly it's at around about the $50,000 mark. So we should see a price around about this level here within the next few months before the halving. This is where it's heading for. And it just seems to be having a confluence. You're probably wondering what these white lines are, this box and this white line here. If we do the Fibonacci retracement from 69,000, where we topped off, to the bottom at 15,400, you can see that the white box here is exactly at the 61.8, the golden pocket as we call it, between the 61 and the 65%. And the white line here is the 78.6 Fibonacci at 50,000. And this is where the pi cycle is now having a confluence. So with a high degree of probability, based on the historical narrative of the past few cycles, this is where, with a higher degree of probability, we're going to be coming up to before April next year. Now, there was another indicator which I've been showing you alongside the pi cycle called the RSI MTF, which is the RSI on a multiple time frame. That's where the MTF comes from, and it's the RSI that's smoothed over that time period. And because it's not available on the BLX, we'll have to go to the current price chart. Both the MTF and the Pi cycle have been around about the same price, but in this cycle there is a divergence here. So what we have this time is two targets: the Pi cycle target at 50,000 and the RSI MTF, which is currently at 42,000. But if you've noticed something, that is that as the price rises, the RSI, so it's coming down. So as the price comes up, this is going to be around about into this box here at around about the 40,000. So this is where this chart would tell us that we're going to be getting some sort of a resistance at this yellow line around the same point as the 61.8 golden pocket. So be aware of that. So what we could get is basically a price rise into this box here to meet this RSI line, get a rejection and come back and hit the Pi cycle anywhere around here, around the $50,000 mark. And that would make sense if we zoom out, because at the $40,000 mark, you can see there's a lot of confluence here, right at this $40,000 mark. So a lot of resistance here, resistance, support, support, and a series of support and resistance all along here. So this is a critical line here at 40,000. And similarly, at the 50,000, if we look left here, you can see a lot of resistance here, resistance, support, and support here, and a lot there as well. So these are two critical areas where it looks to be, with a higher degree of probability, going to be at least a rejection here and then possibly a rejection at the 50,000. So there looks like two rejections along the way here before we get to the halving with this red line in April 2024. And the reason why those two indicators are important is because as we are coming before the halving, there are opportunities to trade both in the long term and as well as in the short term. So as you know, we've had a long-term portfolio with the Wisdom Bites channel here, which we timed absolutely perfectly, both here at the first bottom and then the second bottom here. So this is where we were accumulating. If you've been watching my videos, you'll know that this is where we were accumulating here. And since then, we've had these points of reference with the Pi cycle and the RSI MTF. These were the points where we were going to accumulate in the long-term portfolio with a view to buying back with the pullback that we're expecting here. So this was our first strategic move in the long-term portfolio. And the makeup of the long-term portfolio is with the Bitcoin miners, not with Bitcoin, because of the leverage play that the Bitcoin miners have against the Bitcoin price. And also along this way, we were doing swing trades, which we've been doing with the private Bitcoin miners club. And we've got around about 6 or 7 60-day cycles to go before we get to the top here at the end of 2025. And to give you some insight into those swing trades that we've had since about March this year, and our record so far has been on round 1 swing trades. So these were the achievements on the first round of the swing trades back in March 2023. So this year we've managed to achieve these ones here, and on some of them we took profits in between as well. Then in the second round, from July, these were the percentage increases of the 4 trades that we had. And just to be transparent, on the third round of the swing trades, because our trades are based on the 60-day cycles, as we know, we've had 2 failed cycles. So the last 2 trades were stopped out both here and here in the 2 failed cycles. And that's the importance of having stop losses, so that if the price goes below a certain point, you only lose a small amount of money. And in the current round that we've got, which started just last week, we have 3 trades going with exact entry points and exit points and the stop losses as given to the private members. And so far, up to yesterday's close, the price rises have been 11%, 35% and -4%. But if you look over here, during this period, they've been as high as 32%, 39% and 20%. And because they've been as high as that, our first targets, which I gave to all the members, have all been met. So in the last few days, we've just had a little bit of a pullback, which has brought the percentage increase to these levels here. But what this does is to present a wonderful opportunity to get back in. And for me, these swing trades are an opportunity to ride the Bitcoin miners to the recent highs in July, which means that there is still anywhere between 80 to 120% increases still to come with these Bitcoin miners. And our whole thesis and the narrative at the Bitcoin Miners Club is based on this particular leverage play. If you compare Bitcoin from the COVID situation, which occurred before the halving, the Bitcoin price over that 2-year period increased by about 16x. And if you compare that with some of the miners, just to give you some comparison, Riot Platforms, one of the main miners, actually increased from the bottom of the COVID situation here, and it gave us 156x compared to the 16x of Bitcoin. And just to give you another comparison with one of the other miners that had a conservative run-up, that was Hut 8, which was producing Bitcoins at the time of the COVID situation. From there to its top, it increased 43x. So even on the conservative one, it outperformed the Bitcoin. And finally, Marathon Digital Holdings, from the bottom of the COVID situation to the top, had a very big increase by 236x. So while the Bitcoin miners do vary, this is where we have to really choose the fastest horses amongst a field of 20 Bitcoin miners. And if you want to join us at the Bitcoin Miners Club, all you have to do is just click the join button here. For the price of a coffee per week, we do a dedicated video every single Wednesday covering the Bitcoin miners, the swing trades, the long-term portfolio, as well as look at the undervalued Bitcoin miners along the way, which may have fallen disproportionately. There's no obligation, there's not a contract, and you can cancel at any time. So you can join whenever you want and you can cancel whenever you want. Okay, so I'm going to leave it there. I hope you found value in the video. If you did, then please remember to click the like button and to subscribe and to turn on the notification bell. If you have any comments, questions or suggestions, leave them in the comments below. Until the next time, take care, stay safe, and I'll see you in the next video. Bye for now.